Well, good morning, ladies and gentlemen, and welcome to our second annual Ottawa Market Outlook Breakfast. My name is Sean Hamilton, the Managing Director of the CBRE Ottawa office, and we are excited to host you again this year. The pace of 2017, as can be seen from the video we played, and the prospects for a strong 2018 continue to be positive drivers for both Canada and the City of Ottawa as a whole. Now today, we have two passionate speakers. First, Paul Morisuti will give you a national overview and what he's seeing in the Canadian commercial real estate markets. And second, Jenna Sudds will speak to you on Ottawa technology and the sense of community that has emerged in this sector over the course of the last few years. Now finally, I will speak to you on what we are seeing on a local front in Ottawa's industrial and office real estate. Now, true to last year, many of our themes will be thematic and high level, and like footprints in the snow, our intent is to show you a way forward rather than analyze each and every step taken. I would ask you to think on the symbolism of today's venue, building a gathering place that showcases the world of technology in the envelope of a former industrial building. Change is constant and change is exciting, for in the act of change, there are opportunities for us all. Today, however, it is not just about change, but it is about the pace of change. So with that, I would like you to join me in welcoming Paul Morisuti.
Thank you, Sean. Good morning, everybody. This morning, we're going to talk about the Canadian commercial real estate market and Leonardo da Vinci. And in a minute, I'll explain why we think that someone who could paint the Mona Lisa, design a helicopter, and write poetry is more relevant today than ever before. But first, some background. We're currently 9 years into an incredible bull run for commercial real estate, and the question that arises more and more frequently is, have we peaked? And it certainly is a valid question based on any number of metrics. Record low cap rates, record low values, or record high values, sorry, record vacancy levels, record unemployment, and record investment levels. So to some, it feels like a market that is pretty tightly wound up, and it begs the question, where do we go from here? Because as we all know, markets do not go up in perpetuity, and the reminders are everywhere. David Rosenberg recently told us to enjoy it while you can, because the next downward cycle will hit us before year end. Niall Ferguson is predicting another global financial crisis, and Boston Consulting warns of 15 years of potentially anemic growth. And the U.S. exit from the Iran nuclear deal is a stark reminder of the impact that global geopolitics play. But in 2018, as virtually every aspect of our business is buffeted by change, we would argue that success today is much less reliant on where we are in the cycle than on how we adapt to these changes. Today, creativity, innovation, and challenging traditional conventions about real estate are more important than ever. Which brings me to this guy. As we walk through today's presentation, keep in mind some of the lessons that can be learned from someone who combined art, engineering, and science. Don't think in silos or in disciplines. Break away from existing assumptions. Connect the unconnected, and be passionately curious. Through that prism, we're going to focus on specific issues: interest rates, capital market activity, the ongoing impact of technology, and market fundamentals. You might say from the poetic to the prosaic. So let's start with interest rates. Over the last 12 months, and on the back of very strong economic performance, the Bank of Canada raised rates 3 times. And notwithstanding the recent pause in rates, 10-year Canada bond yields are now 30 basis points higher than they were in 2017, and 60 bips higher than in 2016. At the same time, cap rates actually came in last year. So with the combination of rising interest rates and compressing cap rates, we now have spreads at or below the 10-year average across all major asset classes. And with every bank in Canada forecasting more increases in 2018, the spread will likely tighten further. So this appears to be an inflection point. If this tightening continues, it means there could be upward pressure on cap rates, or at the very least, it would appear to officially signal the end of the era of cap rate compression. Now, of course, there are mitigating factors. Firstly, there's a limit to how high and how fast the Bank of Canada can move. We all know how the housing market has performed over the past decade, and we also all know that Canadian households are the most indebted in the G7. This means that rate hikes pack a serious punch by having an immediate and direct impact on the finances of most Canadians. When you factor in the additional impact of the new mortgage regulations, as well as uncertainty surrounding trade and NAFTA, the Bank of Canada will have no choice but to be cautious, something they readily admit. And while we fixate on interest rates and their impact on cap rates, remember that interest rates will only go up in response to an inflationary economy. And an inflationary economy means job growth, it means rental rate growth, NOI growth, etc. We shouldn't lose sight of that part of the equation. Now, on the cap rate side, the lowest yields are typically reflected by one of two types of property. Number one, trophy assets located in gateway markets where the opportunity to buy an asset that rarely comes to market is much more important than where we are in the cycle. And number two, assets with compelling growth potential, either rental growth or redevelopment potential. Those are the types of assets where we saw cap rate compression last year and where capital remains focused. Capital market investment activity was broadly based in 2017, with pension funds reflecting the highest level of activity since 2008, with most of these purchases reflecting rarely available marquee assets. REITs reduced their buying activity for the fifth year in a row as their growth strategies mature beyond acquisitions. REIT returns were a healthy 10% overall, notwithstanding interest rate pressure and continued negative sentiment surrounding retail in Alberta. Now, foreign capital into Canada was lower than 2016's record amount, with many buyers having their wings clipped as a result of capital controls in China. Now, Asian buyers may have retreated from mega deals, but they are still making their presence known, especially on the land side. And while it appears that we are late cycle, capital is not simply retreating to the sidelines. It is being creative, it is being innovative. And here's a few examples. Summit recently announced a JV to build and own state-of-the-art data centers, given the explosive growth in data creation and storage. Here's a quick fact. 90% of the world's data was created in the last 2 years. Quick fact number two. In the US last year, there were 48 data center deals totaling nearly $20 billion. That is double the total 2015 and 2016 volumes combined. RioCan announced that it will be selling approximately 100 assets in smaller markets in order to focus exclusively on Canada's 6 largest markets, where rental growth and intensification potential is much higher. Buyer interest has been quite good, and RioCan is actually already well through the program. Smart Centres is partnering with Revera to develop new retirement residences across Canada. And the recent CREIT Choice Properties announcement is another example of the drive to create value, in this case via scale and diversification. Slate made a contrarian bet on Alberta office, buying heavily discounted office buildings at what may very well be the bottom of that market. And in this regard, they seem to be following the investment axiom: when everybody thinks that the market is at its worst, that's usually a good time to buy. Now, also announced this year is the Blackstone takeover of PIREIT. At a conference recently, Jonathan Gray, who owns Blackstone's who heads Blackstone's global real estate group, said that Blackstone likes to buy great assets at discounted prices. Well, they're paying a 28% premium to PIREIT's unit price, and the deal reflects an implied yield of 4.8%. So at first blush, that doesn't seem like a discounted price. Well, I think Blackstone would argue that it is, so just consider this. For every $1 billion in online sales, we need approximately 1.3 million square feet of distribution space. Canada lags the world in online sales, but this is expected to grow steadily. It has never been harder to develop land because of real estate costs and entitlement issues, and in some markets, we are literally running out of land. Now, the result of all that? Well, Blackstone feels that Canadian industrial will continue to exhibit very strong rental growth, and it's pretty hard to argue with that logic. I'm sure Blackstone was also aware that Canadian industrial REITs are undervalued globally, whether you're looking at price to NAV or price to FFO, funds from operations. Now, the media narrative that retail is dying has impacted all mall stocks, both in Canada and the US, and since very little attention is being paid to portfolio differentiation, a buying opportunity has been created. Brookfield recently submitted a bid to acquire the 2/3 of GGP that it doesn't already own. GGP owns high-quality regional shopping centers. As of Q4 2017, occupancy in these malls was almost 97%. Same place NOI had grown at 4 to 6%, and year-over-year rental lift was almost 15%. These don't sound like dying malls to me. Unibail-Rodamco announced that they would acquire Westfield, consolidating a portfolio of some of the best mall assets in the world. Now, collectively, these two deals represent sophisticated capital making a $30 billion bet that not all retail is created equally and that the best assets are well positioned to thrive. In terms of overall returns, multifamily and industrial led the way. Safe, boring, reliable, much like being married to an accountant, I would assume. This speaks, I'm an appraiser, I can say that. This speaks to these sectors' strong fundamentals and insatiable investor demand. Now, before moving on to fundamentals, as Sean mentioned earlier, we do feel we need to address technology since the pace of technological change has been so dramatic and its effects so far-reaching. And while we clearly can't cover everything, we've chosen to highlight a few examples of how quickly the sands are shifting and, more importantly, how these changes connect to physical real estate. Let's start with autonomous vehicles. Cars aren't going to disappear anytime soon, but broad adoption is going to happen faster than most people think. Now, keep in mind that the average car is parked 95% of the time. Once driverless technology is in place, it will be absurd to own an asset you rarely use when you can download an app that will send a car to your door. And the disruption to urban mobility will be massive. Now, we're not going to get into every possible implication because they're endless, but if you accept that autonomous vehicles are at some point coming, how do you prepare? How do you future-proof buildings today when the need for parking is still very real? Well, we're already seeing some examples of parking lots transforming from this to this. Developers have started designing flexible spaces that can easily convert to other uses by making sure the floors are level between ramps, raising the floor height, adding knockout panels and modular sections. The space anticipates new uses such as office space, gyms, shops, etc. I'm not sure how you can develop anything without understanding as best possible how this dynamic is going to play out. And another area where we see technology and bricks and mortar intersecting is the evolution of WeWork. Now, the common perception of WeWork is that they are a co-working business geared towards startups and entrepreneurs. But they have evolved well beyond this. Today, between 25 and 30% of WeWork's occupancy and up to a third of their revenue comes from enterprise companies. These are companies that employ more than 1,000 people. It is the fastest growing segment of WeWork. They've also launched Power by We, which is essentially an outsourcing service. And as part of this service, the data that it collects on how people work is being turned into products for its enterprise users. Well, you know who else provides these kinds of outsourcing services? CBRE and JLL and Colliers and Brookfield Johnson Controls. In every aspect of our business, whether service providers, asset managers, etc., our traditional competitors might not be the only ones in the future. And what about conventional landlords? Do WeWork and other co-working companies pose a threat to them? Well, some landlords are already hedging their bets. Mort Zuckerman, formerly of Boston Properties, the largest owner of office space in the US, was an early investor in WeWork. And at the same time, WeWork will be a 200,000 square foot anchor tenant in Boston Properties' Navy Yard project in New York. Now, before leaving technology, I have a quick question for you. How well prepared do you think the real estate industry is to understand and adapt to these shifting technology sands? I recently reviewed the management teams at as many real estate companies as I could, both public and private. And I have to be honest with you, I did not see a lot of tech experience in the C-suite. And I don't mean the people who oversee the servers and hand out the laptops. I mean those who can provide true strategic guidance. This is one area where the real estate industry is definitely going to have to evolve. So let's move into market fundamentals. As we move deeper into 2018, fundamentals at the property level are strong and regional disparities are diminishing. Let's do a quick flyover and then we'll spend a bit more time on retail since it simply needs a bit more time. So starting with office, in the office sector, job growth is at record levels, new supply is in check, technology-based demand is strong, and while there is continued weakness in Alberta, absorption has been positive for the past 2 quarters. Multifamily, a perennial rock star. Low vacancy, increasing immigration, modest new supply, huge investor demand. And once again, the weakness in Alberta is diminishing. Now, industrial. If possible, the Canadian industrial market has performed even better over the past year than anyone would have predicted. We've already touched on some of the metrics. Vacancy at a 16-year low, new supply at a 7-year low. Very strong rental growth, some of the lowest vacancy rates in North America. And this is leading some to wonder when we might actually go vertical. Goldman Sachs is partnering to build a 3-story complex in Brooklyn. Why Brooklyn? Because it is close to people, which is becoming an increasingly valuable attribute. This will be the first building in North America to offer multi-level distribution and warehouse space. Now, the big industrial wildcard, of course, is NAFTA, but recent talks have been, I think, encouraging, and hopes for a deal are probably higher today than they were at the start of the year. But with this White House, it's anyone's guess. Retail. Well, as we all know, the media narrative surrounding retail has been overwhelmingly negative, and the retail is dying drumbeat is getting louder. Now, much of that is influenced by US-centric headlines that are much less applicable to Canada, and some of it is oversimplification. Retail is obviously evolving in response to new technology and a secular shift in consumer shopping habits, but some of it has adapted and is thriving. Some of it will be reinvented, and some of it, yes, is roadkill. But you can't simply paint it all with one brush. So with that said, let's discuss some of the more notable themes that we see in retail. Well, the concept of the anchor tenant is changing, and clearly the shopping center is transitioning away from the department store anchor model. Sears, of course, is the latest department store casualty, although it was always a matter of when rather than if. Sears will add almost 15 million square feet to a retail landscape that is still dealing with over 4 million square feet of vacant Target space. Some of it will release quickly and at much higher rents. Some of it will not, adding to the vacancy overhang. Now, the one sector that almost everyone thought was virtually immune to disruption is the grocery sector. Well, not anymore. And this is a sector that already operates on razor-thin margins. And just like grocery stores, pharmacies could be headed for a shakeup. No sector is immune, and the implications for neighborhood shopping centers are significant. Now, given the overarching negative sentiment towards all things retail, it is not surprising that retail REITs as a whole underperformed in 2017. However, the operational performance of many retail REITs has actually been quite sound. The assets most exposed to e-commerce headwinds are the undifferentiated assets, and I'm sure you can all picture them. These are malls that are tired and dated with identical formats, heavy on mid-market fashion, and unremarkable anchors. Now, RBC actually looked at NOI growth in the retail REIT sector by category, and you can see how the Tier 2 and Tier 3 enclosed malls have lagged over the past few years, and how dramatically this performance has changed in the past decade. If we had to summarize this trend into one soundbite, it would be this: retail isn't dead. Boring retail is. Now, lost in the endless headlines proclaiming the retail apocalypse is a pretty big mitigating factor. The land under many malls in the country has tripled in value over the past few years. Now, this isn't a silver bullet for every asset, but it certainly can't be forgotten, and it is an essential ingredient in the reinvention of many retail assets. Retail development and redevelopment continues, but it's not the traditional mall being built. The amazing Brentwood in Burnaby combines residential, restaurants, and entertainment with luxury retail. It is the very definition of placemaking. Trinity Groves, just outside of Dallas, contains no stores at all. It's all restaurants, restaurant incubators, a culinary center, a brewery, etc. This is a pretty hard to replicate this experience online. Now, change in retail is relentless, we know this, but the retail sector is actually a pretty good proxy for where all asset classes, where change is also accelerating and where complacency just won't cut it. Skills have to broaden. Today, you have to be able to paint a masterpiece and innovate for the future. Now, our collective business has been on such a phenomenal run that logic says it should end soon, right? The conundrum, of course, is the when, the why, and the how. But it bears repeating that the commercial real estate industry is not over-leveraged. Our fundamentals are solid. Our ownership base is strong and well-capitalized. Our immigration policies are attractive to global talent. And our government, while at times flawed, at least is not batshit crazy. And other than the unpredictable, there is no reason to believe that this run won't be extended. We tend to be obsessed with where we are in the cycle, but real estate is a long game. There will be dislocation, change, obsolescence, failure, and rebirth. The industry is morphing from one that owns boxes that contain long-term leases that generate predictable cash flow to something that requires a higher degree of stewardship. Vision and creativity will be rewarded. Now, you used to be able to get away with saying that you're either right brain or left brain. Today, you really have to have both. Success in navigating our changing world is going to mean a little less of this and a lot more of this. Da Vinci said there were three types of people: those who see when they are shown, and those who do not see. Let's make sure we don't find ourselves in the last category. Thank you very much.
Thank you, Paul. Our next presenter is passionate about the city and passionate about the technology community in Ottawa. As Canada's first Executive Director of the Canada North BIA, Jenna was the leader in helping to bring a unified culture within our West End technology clusters, and there's a new energy that comes from this sense of community. In a world where culture eats strategy for breakfast, this it factor is an extremely important ingredient for growth as Ottawa looks to cement its position as a destination for both international and local business to grow. So please join me in welcoming Jenna Suds.
Good morning, and thank you for those kind words and kind introduction. As mentioned, my name is Jenna Suds, and it is a pleasure to be here this morning. As you've realized, I am not a commercial real estate broker. But having said that, I have spent some time with a number of you in the room here during my time with the Canada North Business Association, and incredibly value the work that you do here in our city and across the country. So I am the founding executive director now of the CIO Strategy Council. This is a national technology council that really looks to support Canadian innovation. I spend my days now with some of the brightest technology minds in our country. And at my heart of hearts, I am certainly a technology enthusiast, a community builder, a mother, and an advocate for all types of business and entrepreneurship. I've studied our city and the impact that it has on people and technology, and how that translates and impacts all of us in the room here today. The decisions that we are making now, collectively, impacts our city in ways that we don't even imagine currently, and will impact our future generations for decades to come. There really is a paradigm shift happening now in our city. The power of community and culture in the face of technology and disruption is really a fascinating topic. We're in the midst of the fourth industrial revolution, which has far-reaching implications, including this paradigm shift that I've mentioned. So let me explain that. Disruption is a process. For example, disruption in the context of this paradigm shift of culture could be a process whereby a small company with very few resources, possibly in a basement, is able to successfully challenge an existing business model and disrupt it. Innovation, a term which is wildly used in today's environment, but in this context, I'm referring to innovation that creates a new market and a new value stream that eventually, again, disrupts an existing market completely. And the result of this innovative disruption is change. Change, I would argue, for the better. Change that's creating new and innovative ways to do business. Disruption, think of Uber to the taxi industry. Think of Airbnb to the hotel industry. Disruption, think of how we consume movies and TV today, and how Netflix has totally disrupted Blockbuster, for example. We're in the midst of witnessing how Amazon is what they are doing to disrupt retailers, as Paul has shared. And how has disruption and this new innovation impacted us personally, collectively? We'll circle back to this a little later. I have been engaged in Ottawa's economic development activities for a number of years. I'm an economist by study, and I love to grow business and to grow our city. When I look at the number of cranes that have graced our skyline over the last few years, it makes me happy, genuinely. We're at a point in time, particularly in our downtown, where we're benefiting from some major projects in our city. For example, the LRT, which I'm sure we're all familiar with as it transforms our city. This is Ottawa's largest transportation infrastructure project since the building of the Rideau Canal. This first phase, at over a $2 billion investment, that strives to rapidly move people through our downtown. So let's not forget that this will get thousands of buses off our downtown roads. Think about this. Imagine what those downtown roads are going to look like without buses. How can we reimagine those roads and that space to breathe life into these streets? This is a massive opportunity for our city. The Ottawa Arts Gallery is another example, a redevelopment in the downtown core that really is raising the profile of arts in our city and our downtown. Zibi, another example, building a world-class sustainable community, a purpose-built community. The development of LeBreton Flats, our new central library, and of course, stage 2 and I hope stage 3 of LRT. It's truly remarkable what's happening in our city right now. However, a question that I continually ask myself, and a challenge for all of you in the commercial real estate business, is to ask yourself how this technology and this new disruptive technology is going to impact our city and our communities. And are we ready? Are we embracing it in our new projects and in building for the future? I currently spend a lot of my brain power, what little that there is, on the topics of digital disruption and artificial intelligence. We now live in a very digital world where 70% of the world's population has a cell phone. Our children are literally born and programmed how to work these devices, oftentimes better than ourselves, my children for sure. We live in this digital world. We see the world's largest and most successful companies, the likes of Apple and Google, for example, and this isn't going to change anytime soon. Artificial intelligence, or AI, literally refers to intelligence demonstrated by machines. A few examples, and actually Paul mentioned earlier, one that I think is very relatable is autonomous vehicles. Ottawa is actually incredibly lucky in this industry in that we have over 70 companies in Ottawa that are developing autonomous vehicle-related technologies. And we also have the world's #1 automobile software company here in Ottawa, which is BlackBerry QNX. Ottawa also is fortunate in that BlackBerry QNX is one of only 3 companies in Ontario that are licensed to test their autonomous vehicle on public roads, on our streets. And they've been doing just that in the Canada North Technology Park over the last 6 months. This is the only place in Canada where an autonomous vehicle is being tested connected to live city infrastructure, our traffic signals, the only place in Canada where this is happening, right here in Ottawa. Another example of artificial intelligence that you're likely interacting is chatbots. Chatbots that are answering your questions and serving your needs on numerous websites currently. This is machines that literally have built-in intelligence and are conversing with you. But what about our built environments? How can AI improve these built environments? AI can give priorities. So for example, the priority could be keep everyone comfortable in this building. And instead of having to follow rigid programming, as has been the case historically, i.e. keep the space at 72 degrees, AI can help. AI can maximize occupant comfort, minimize energy usage in buildings, and also keep buildings safe. The ability to leverage artificial intelligence in building systems is now, it's here. And this application is ready to go. If you haven't thought of it already as you build or as you renovate, you could be the next Blockbuster, or you could be the next Uber. You will be disrupted, or you will disrupt. It is truly your choice. Lastly, the ability of artificial intelligence to digest massive amounts of data is truly transformational. Data is the new oil. And I tell you this because as you adopt new technologies in your personal lives, but also in your professional capacities, this data lives forever. When you leverage a digital world, you are leaving a footprint. And when you manage a digital world, it is your responsibility to manage that digital footprint left behind by others. And you have a responsibility to safeguard that data. This is truly an area that can destroy a company. Think of Cambridge Analytica and the role that Facebook played in that recent scandal. I cannot stress enough the importance that if your business is collecting personal data through any type of digital system, that you need to be transparent with your clients as to what their data may be used for and treat it as if it's your own, or better. At current, Canada is, quite frankly, very lax in our legislation and regulations as it pertains to data privacy and analytics. But I do believe that we're seeing signs that our government is taking this seriously and is in the process of building our first ever national data strategy due to the importance of this topic. So I'm sure that we will see new regulations coming in this area. On a happier note, possibly, how does this digital transformation, artificial intelligence, and big data, how does this impact our workforce, but perhaps more importantly to you, our workplaces? We know that the future of work is changing drastically in so many ways. Automation means that some menial, lower-skilled jobs will be replaced by automation, AI, robotics. But the jobs of the future will still require our human input, particularly jobs that require complex problem solving, critical thinking, creativity. Computers aren't that creative, and people management. 42% of the jobs in Canada have been identified as having a high risk of being affected by automation. However, equally important to remember is that 36% of Canadian jobs, Canadian labor, is considered to be low risk. And through this process, it is forecast that over 700,000 new jobs, we don't even know exist yet, will be created. So what role can we play in making this transition smooth? How can you, the real estate industry, get ahead of this curve and create workplaces for the future? We really have now come full circle. I've shared with you my thoughts on city building that's currently happening within our city. I've shared with you my thoughts on technology and how technology, specifically AI, in the digital world is posed to disrupt our lives and our city, and how our workplaces and careers of the future are really under siege. How is Ottawa, or how can Ottawa embrace this change? I believe that Ottawa is well positioned to capitalize on technological change and this fourth industrial revolution that's underway. A great example of this is the Canada North Technology Park, a park that is home currently to over 500 businesses, where 21,000 people go to work every day, that's contributing almost $8 billion to Canada's gross domestic product every year. It is the second largest employment node in our city after downtown, and one of our largest economic drivers. This park was really built on a vision and a dream. The vision originally of Bill Tarrant, later with the vision of Sir Terence Matthews. It created a satellite community at the time, a garden city, as it was called in Canada, where the vision was to create a community where people could both live and work. So Canada was built. So we all know it as it is today. Originally, the Canada Technology Park, as it was called, came to be with digital and atomic energy as early inhabitants. The tech sector in Canada has consistently grown. Even with the demise of Nortel, there were many spin-offs that were created and innovation that occurred and continued. And this is what I mean about the power of community and culture. Culture really does make cities. And culture also, as we all know, makes or breaks companies. However, lastly, culture will always trump strategy. And I believe that Ottawa is posed for success if we can get a few things right with our culture. First of all, connectivity. And I don't mean just internet connectivity, although I know that is a struggle in some parts, in some buildings in our city. But Wi-Fi really is becoming a utility. I mean, what I want to see is lightning speed connectivity, ultra-fast fiber, everywhere, on our buses, in our homes, in our buildings, our businesses, in our public spaces. Ottawa should and could be a leader in this space. We were literally the birthplace of so many telecommunications companies and innovations, and we can own this with leadership and dedication. Secondly, in building on this last point, we need to become a smart city. There are some smart city applications, and as I mentioned, the autonomous vehicle testbed is one example. The federal government currently has a smart city challenge across Canada to cities, recently closed the first round of applications to really fund and motivate cities across the country to develop the smartest community that they can. Ottawa has submitted an application for this, and whether this means health applications that better connect residents to better health outcomes or services that could genuinely save lives, or whether this means our transportation systems and built infrastructures that are self-monitoring, sustainable, and smart. We really have an opportunity here in Ottawa to be the smartest city in our country. We are a capital city, so perhaps we strive for the smartest capital city even. I've had the privilege of participating over the last year in the Ottawa Beyond 2036 Sounding Board. And this is an opportunity to provide input to the city's scenario-based planning exercise that's currently ongoing, looking at the future of our city. Through those meetings and conversations, we've discussed many disruptors, major disruptors to our city. Things like climate change, public health and an aging society, food and water security, mobility and car dependence, and the state of our urban form. The one area that I haven't mentioned that I will touch on briefly is sustainability. Of course, there are many facets to sustainability, but today it's not enough for the buildings that we live and work in to be beautiful, big, and bold. With climate change looming as a threat and the need for renewable energy sources ever more pressing, skyscrapers, office buildings, residential units need to be green. And you can lead by examples. You can create the culture that supports this mission by minimizing negative environmental impact of buildings and building in efficiency and moderation. So I hope that I have demonstrated with you today that the potential of Ottawa is great. But your leadership is required. All of us in the room, we collectively play a role in ensuring that Ottawa continues to thrive and to grow. We know that disruptive innovation leads to change, and that this change impacts and shapes the culture of our workplaces and our city. I'd like to leave you today with one thought, and I hope that it inspires you to action, and that is that standing still is the fastest way of moving backwards in a rapidly changing world. Thank you.
Thank you, Jenna. So last year, we discussed the office and the industrial markets for Ottawa. On the office front, the theme was about people, how people interact with the real estate that houses them. Does the real estate attract people, engage them? Does it harness their abilities? On the industrial front, the themes surrounded non-conventional thinking, dealing with alternative users out of the convention in different nodes than we were used to. This year, we want to discuss what other influencers and disruptors might be coming down the pipe that will shape real estate demand and usage in Ottawa. Our intent is to help you plan for the future. Now, our industry has shown time and again that the ability to evolve, adapt, and predict the future is key to managing success. The very building we are in right now is a testament to the themes that we need to adapt. This building was the former Morrison Lamothe Bakery that in 1967 became the temporary new home of the Museum of Science and Technology. In effect, the museum itself became one of the first disruptive users, alternative users, a trend that we are seeing today. Now, why was this building available in the first place? Well, in short, disruptive technology. You see, grocery stores at the time had just put in-store bakeries into the grocery chains, and Morrison Lamothe needed to rejig their distribution channels in order to compete. As a result, they built a new building that rendered the building that we're in right now obsolete. So it seems that alternative users and disruptive technologies have always been around. It's just the pace of change that is different. So let me walk you through the forces that our industrial market is being shaped by, and to give you some thought to what landlords and tenants should be thinking for the year coming ahead. So last year, we told you that 87% of our city's growth, 1.3 million square feet, happened in the west end of our city. Now, this shattered our pre-existing notion that the east end of the city, which represents approximately 46% of our industrial inventory, was the main industrial engine for our city. Now, despite strong growth over the last few years in the West End, it looks like next year, this time, a significant headline is going to be that Boundary Road is going to be Ottawa's next industrial hotspot with 1 million square feet of development and leasing. I don't know about you, I did not see this coming. To put this in perspective, the development on Boundary Road is going to represent the single largest industrial building ever constructed in the city, the largest ever increase in leasing activity in the city, and this single development is going to represent or increase our inventory by 3% and represent 3 years' worth of absorption, all in one single development. It's not just about change, it's about the pace of change. But in a city with small average building sizes, 37,000 square feet, with tightening vacancy rates in and around 4.3%, with limited central developable land, and with service industrial land prices having doubled in the last decade, it's no wonder that Boundary Road started to look attractive. And given on top of that our main traditional industrial nodes are landlocked, well, frankly, like so many of us as we age, there's really nowhere to grow but outwards. Last year, it was the West. This year, it's the East. And it's conceivable that much of our new industrial growth will happen as a halo effect to this new development. Now we just need to figure how to absorb all of this industrial space in an industrial node that didn't really exist a year ago. So what could drive this pace of change? Well, let me tell you a story. It's January 12, 2010, and it's Barrie, Ontario, and 100 OPP officers seized $30 million worth of marijuana plants in what is seen as the largest and most sophisticated grow-op in Canadian history. Fast forward to today, and stories like this are a thing of the past, as Canopy Growth, for example, is set to have over 5.6 million square feet of domestic growing space across the country. And they are only one of 104 licensees able to produce marijuana in Canada, 57 of which are in Ontario alone. All of this with the first license being issued in September of 2013. So in 4.5 years, we have gone from a complete black market occupying 0 square feet to a revenue-generating industry occupying in the millions of square feet. It's not just about change. It's about the pace of change. But what could this mean for Ottawa? Well, Bloomberg reported in February of this year that it was conceivable that space occupied by the marijuana industry would need to quintuple to 8 million square feet by 2020. Now, agree or disagree with this figure, the truth is that marijuana use is having an impact on industrial real estate. Just recently, the former Nestle plant in Chesterville, about 370,000 square feet, and 550,000 square feet of greenhouse space in Greeley have been proposed to be used for marijuana grow operations. This is over and above Canopy having bought the Hershey plant at 460,000 square feet. Demand is clearly surrounding the National Capital Area. Industry insiders suggest that to be competitive, the scale of grow operations needs to be between 125,000 and 150,000 square feet and up. Some operators prefer existing vacant buildings at distressed rates, while others prefer to build specialized structures from the ground up in order to control every variable. As a comparator, in the U.S., grow operations typically pay a premium over market. In Oregon, they pay a 3-to-1 premium, whereas in Colorado, it's closer to a 10-to-1 premium. So if that trend holds true for Canada, it is conceivable that there's a possibility for rental upside in buildings who previously would have had limited demand. Given the scale of these developments, we anticipate that growth will be concentrated outside of the Greenbelt. So I say to you, expect the following. Look for three things to happen outside of the Greenbelt. One, the cannabis industry possibly selling or saving small-town Ontario, taking large abandoned factories and large vacant blocks of space. Look for land sales in suburban areas to increase in volume for custom build, remembering that the marijuana industry falls under an industrial use, not an agricultural use. And three, I ask you to give thought to the concept of airport development. We look to our friends in Edmonton, who right now are developing 750,000 square feet of grow operation space on 20 acres of federally owned land on the Edmonton airport. Could the same thing happen here in Ottawa for companies looking to open international markets? I don't recall there ever being a time when there was an industry that could grow rural industrial real estate so significantly. Now, I'm not sure on the longevity of this industry, if we're overserviced, if we're underserviced, and the exit strategy in some of these more esoteric builds remains to be seen. But the reality is that the pace of change is faster than ever. Inside the Greenbelt and looking in the east, we've noticed an interesting trend. Once vacancy approaches and breaks through the 4% barrier, there is a bounce upwards in real estate. This has happened 6 times since 2003. This could be coincidence, but a more likely reason would be that once vacancy approaches this 4% barrier, the tightness of the market becomes somewhat stifling, and companies requiring growth are forced to move to new nodes outside of the East End. This isn't an uncommon phenomenon in real estate. We see it in office buildings where fully leased buildings often pose problems for landlords and tenants alike who need to grow, whereas buildings with 4 to 5% vacancy allow for some wiggle room to accommodate the ebbs and flows of tenant growth. At 4.6% vacancy in the East End, there is still some room for tightening. But the uptick could come in 2019 should Giant Tiger vacate some of their East End premises. This is not necessarily a bad thing, as it will open up space for growth in the East. Now, right now, I would suggest to you that right now is a really good time for any industrial development within the Greenbelt of the city. Demand is strong, rates are strong, and interest rates are low. All of the fundamentals are in place to accommodate a growing industrial tenancy base. The one caution is that we are a small market, so there won't be room for multiple simultaneous developments. So the first to market will likely be the winner. So in conclusion, the industrial market is firing on all cylinders. We have strong demand and lowering vacancy rates within the Greenbelt. We have the mother of all industrial buildings poised for development in the extreme east of the city, potentially acting as a magnet for future growth and development. And we have a repeal to prohibition for large blocks of space, or that could create demand for large blocks of space and industrial land in rural areas on a scale that could be unprecedented. 2018 will be a strong year for industrial real estate. Today, on the office front, I want to talk to you about the things we talked about last year and what came true and what didn't. Looking at how we define our core and should we need to redefine our core, and talk about how new age economy tenants view the affordability of rent. So last year, to reiterate, we told you that we thought government was a diminished driver, that tech was on the rise, the demand for talent was greater than the supply, and that we needed the right type of thinking and a new way of thinking in order to attract new age economy tenancies into our buildings. Now, every one of these holds true today, save and except for point number 1. Because with a recent spate of hiring and expressions of interest, it appears that the government has reversed course and is set for growth. We're hearing rumors of potential growth in the East End that could substantially lower Class A vacancy rates from the projected 34% that they're supposed to hit once Telesat vacates to the downtown core. Now, perhaps this decline in vacancy rate is due to a scarcity of large block availabilities elsewhere in the city, which is true. But we also suspect that this potential for growth is due by and large to the existence of LRT, which will link our East End to the downtown core, making transit time shorter than a walk from one end of the core to the other. The shining stars of Ottawa growth continue to be the CBDA class, which has shown consistent recovery, going from 6.5% down to 4.5% in the last 3.5 years. And Canada, which has shown a greater range of recovery, falling from almost 19.5% to its current rate of 8.6% over the course of the last 9 years. But I think it's time for us to stop talking about Canada with a sense of amazement and acknowledge this is how Canada is. This is how it's supposed to be, a dynamic, rapidly accelerating engine of growth and knowledge. Canada will continue to grow. And with the largest concentration of tenants in excess of 20,000 square feet, and with few large blocks of space available, I suggest to you that new development is likely around the corner. Same as with the industrial market, Canada is a small market, so there won't be room for everyone at the same time. So first to market will likely be in an extremely advantageous position. The downtown continues to be sought after by an emerging urban technology class tenancy, with the likes of Clipfolio, SurveyMonkey, and Telesat absorbing 150,000 square feet in the core last year. I haven't even mentioned Shopify. But hear this, and this is important. Urban technology now occupies more space in our downtown core than the legal community and the accounting community combined. Only the federal government is larger. So far, tech has been able to expand because of space being left behind by the federal government. But if the federal government begins ramping up leasing, then I sense that urban tech and federal government occupancy will be on a collision course fighting for the same space. So who will win? Well, on one hand, the federal government has covenant, whereas established technology arguably can afford higher rent. So it will be exciting to see how landlords decide. Either way, I sense there will be competition that might make life more interesting for the federal government. My sense is that things won't heat up until the space vacated by DND is absorbed by all of these users. Once the space has been taken off the market, there are exciting new developments just to the west of our core that can accommodate growth at LeBreton Flats. So right now at LeBreton Flats, we have 5 new developments underway in the proposal stage. We have ZB, we have Trinity, Rendezvous LeBreton, Invest Ottawa, and Claridge. And to give you a sense of scale, once these developments are completed, we'll have 3 million square feet of office space, 500,000 square feet of retail, almost 10,000 new residential developments, and a festival plaza, sports entertainment hub, community node, the like we haven't seen in this city, seconded only by Lansdowne Park. This node is nestled right on the western edge of our CBD, right at the crossroads of our 2 LRT lines, north-south, east and west. It is a unifier between Ontario and Quebec and will be adjacent to our new proposed public library. When complete, just the office portion of these developments will represent a 30% increase in our downtown A-class vacancy. It's not just about change, it's about the pace of change. Now, let me ask you the question, is this downtown space? Is this suburban space? Is this fringe core space? This pocket will be unlike any other that we have in Ottawa, and logic suggests that it will pull our CBD in a westerly direction. Now, Toronto went through the same phenomenon south of the Gardiner Expressway, which has now become an extension to their core. And for Ottawa, we cannot overstate how significant this node will be towards setting the new vibe, tone, and culture for the city. It's a lot of space, mind you, and some feel that it's fanciful that we could possibly fill it all. But let me walk you through the math of why it might not be so crazy that we can fill the space at LeBreton Flats. So, since Q1 2013, the CBD A-class market has grown by 1.7% in terms of occupied space, whereas Canada has grown by 17.6%. 10% greater growth in Canada than in our CBD. Now, this begs the question, if urban tech and if the urban tech community continues to grow in downtown Ottawa, does it stand to reason that the rate of change of growth in downtown will also change? In short, the answer is yes. How much will it change? Well, we'll see. But I can tell you that if our CBD experienced the same level of growth over the last 5 years as did Canada, we would have a space deficit today in the order of magnitude of about 1.6 million square feet. Now, granted, I do not expect demand to ramp up that quickly. But remember that 5 years ago, we weren't even talking about urban technology, who are now the single largest private sector tenant group in the city. Add on top of that, if the federal government ramps up its leasing, then it's not out of the question that we could hit the numbers required for LeBreton Flats. Now, earlier I spoke to you on technology being able to afford higher rents and that this could create competition for the federal government. I want to explain this to you, as this difference could be a key change for Ottawa going forward. So, according to a report recently completed for Jenna's former group, the Canada North BIA, the average GDP of the Canada tech worker was 3 times higher than that of the average Canadian worker, $255,000 compared to $85,000. Now, on the following chart, I outline the Canadian average compared to some existing private sector tenancies in Ottawa, along with Shopify and the GDP figure outlined in the report for the Canada North BIA. What does this tell us? That for technology companies, the productivity on the basis of revenue per employee is huge. And in a world short on talent, it becomes even more important to protect the productivity of employees. Private sector employees do not represent a cost, they represent a revenue-generating opportunity. So if we look at a tech worker occupying 150 square feet with a production of $255,000 and compare that to the cost of the average public servant, which comes in at about $136,000 once you take into account pensions, benefits, and salary, occupying that same 150 square feet, I ask you, which one do you think is more willing and able to pay more in rent? This fundamental difference explains why rental rate in Ottawa Class A typically lags behind those of Calgary and Toronto. In Calgary, the oil and gas industry has a GDP figure approaching $3 million per employee, whereas Toronto, who's dominated by the financial banking industry, has a GDP of almost $370,000 per employee. So to this point, should urban tech and should the federal government and urban tech start competing for the same space, landlords will get to decide, do they want covenant or do they want return? My suspicion is that the answer will lie somewhere in between. Either way, as we drift to a framework that incorporates a higher segment of tech, we can expect to see our markets behave in accordance with the economy. That is to say, occupancy increases as the economy is good and decreases during more challenging times. The Canada occupancy rate has marched in lockstep in accordance with the ups and downs of the TSX. Their paths are more than just coincidental. And as for downward slides, that's where we hope that federal government presence will insulate us on the downside. So the messages to you are as follows. If you are the government, you might not be the only game in town. And if you don't want costs to rise, then give thought to occupying buildings where tech doesn't want to exist. And grow sooner as opposed to later, as supply will dry up. If you are urban tech, move quickly as existing space will become limited, and don't sweat the small stuff. Not to undermine rent, but to you it's a necessary evil, and talent is your true golden goose. If you're a traditional private sector tenant, I would suggest to you to act quickly, as I would suggest that rental increases could be on the horizon, and again, large blocks of space will dry up. If you're an owner, an investor of buildings, if you have good product, the future should be bright. We anticipate that demand will be strong, and again, as we've evidenced here, that there could be a case for rental increase. And if you own more challenged product, it's time for the out-of-the-box thinking time in order to attract new economy tenancies who also are out-of-the-box thinkers. So I would like to leave you today understanding that the world we live in today is different. The pace of change is greater than ever, both on the industrial front as well as on the office front. What we're seeing today, we could never have predicted 5 years ago, just as in 5 years' time, it will be very difficult to predict what forces might be at play. Paul Morisuti led off with a Renaissance theme. Renaissance is a rebirth, and for Ottawa, the first golden era was the second half of the 1800s, where our timber trade innovation was the largest and most sophisticated in the world. Today, with a tide of tech growing in the midst of strong economic times, it appears as though we are rising again. And like the Renaissance, our recognition and harnessing of the power of the person is ultimately what will lead us on the next phase of our evolution as a city. Thank you so very much for joining us here today.